there is a parallel stock market. It operates alongside the exchanges you know, the NYSE, NASDAQ, the CME. It processes roughly 40% of all U.S. equity volume. Its prices are invisible to the public. Its participants are anonymous. And it almost certainly executed some of your trades without you knowing it existed. It is called a dark pool. And this is episode 3 of Inside the Machine, How Markets Really Work. Welcome, I'm your host. The term dark pool sounds sinister. The reality is more mundane and more illuminating. A dark pool is simply a private trading venue that does not display its order book to the public. Unlike exchanges, which publish every bid and ask in real time, dark pools match orders internally without revealing the prices or participants until after the trade is done. They were not created to deceive retail traders. They were created to solve a specific problem faced by large institutional investors. Imagine you manage a pension fund with $40 billion in assets. You need to sell 5 million shares of Microsoft, a position worth hundreds of millions of dollars. If you submit that order to a public exchange, the order book immediately signals your intention to the market. Algorithmic traders detect the large sell order. They begin selling ahead of you, pushing prices lower before your order fills. By the time your last share trades, the price has moved significantly against you. This problem, the market impact of large orders, is one of the oldest challenges in institutional investing. Dark pools were designed to mitigate it. By trading away from the public order book, large institutions can execute significant orders without telegraphing their intentions to the market. The trade is only reported after execution, once the market impact has already been absorbed. In this sense, dark pools serve a legitimate function. They reduce transaction costs for large institutional investors, which ultimately benefits the end beneficiaries of those funds: pension holders, insurance policyholders, and retail investors in mutual funds. The mechanics of a dark pool trade are straightforward. A large institution submits an order to a dark pool, say, to sell 5 million shares of Microsoft at a price no worse than the current national best bid. The dark pool operator searches for matching orders from other institutions within the pool. If a match is found, the trade executes internally. Neither side is identified to the other, and the transaction is only reported to consolidated tape after the fact. The price at which the trade executes is typically the midpoint between the national best bid and offer, a price better than either side could achieve by buying or selling directly on a public exchange. Both parties to the trade benefit from the absence of market impact. Most dark pools in the United States are operated by major broker-dealers: Goldman Sachs, Morgan Stanley, J.P. Morgan, Credit Suisse, and others, as well as independent operators like Liquidnet, IEX, and various stock exchange operators who run their own dark venues alongside their public markets. The fragmentation of trading across dozens of public exchanges and private dark pools has created a complex ecosystem that requires sophisticated order routing to navigate. When your retail broker routes your order, they are choosing between public exchanges and alternative venues based on factors including likely execution quality, speed, and, as we covered in episode 1, payment for order flow. In June 2014, the New York Attorney General filed a lawsuit against Barclays Capital over the operation of its dark pool, known as Barclays LX. The allegations were specific and damaging. The Attorney General claimed that Barclays had misled institutional clients about the composition of its dark pool, specifically about the presence and activity of high-frequency trading firms within it. Barclays had marketed LX as a safe haven from aggressive HFT strategies, implying that clients could trade in the pool without being picked off by faster algorithmic traders. In reality, the allegation stated, Barclays had actively encouraged HFT firms to participate in LX because their activity increased volume and improved matching rates, metrics that made the pool look more attractive to institutional clients. The very participants Barclays claimed to protect clients from were operating actively inside the pool. Beyond this, Barclays was alleged to have falsified data in marketing materials, showing clients a sanitized view of who was trading in the pool that omitted the most aggressive HFT participants. Barclays settled the case in 2016 for $70 million. At the time, the largest ever fine for dark pool misconduct. The settlement did not require an admission of wrongdoing. The Barclays LX case matters not because dark pools are inherently fraudulent. They are not. But because it illustrated the fundamental tension at the heart of the dark pool ecosystem. Dark pool operators profit from volume. Volume is driven partly by HFT firms, and the institutional clients who use dark pools are often trying to avoid the very HFT activity that makes the pools profitable to operate. The opacity that defines a dark pool, the feature that makes it useful for large institutional orders, also makes it difficult for clients to verify that the pool is operating as described. 3 things to take from this episode. First, accept that some of your trades are executing in dark pools and that this is not necessarily bad. If your broker routes your retail order to a dark pool that provides genuine price improvement at the midpoint, you are getting a better fill than you would on a public exchange. The retail context is different from the institutional context. Your orders are small enough that market impact is not a meaningful concern. What matters is your net execution price. Second, understand why institutional order flow behaves the way it does around major market events. Large institutions often accelerate their dark pool activity ahead of significant index rebalancing events, earnings announcements, and major data releases, precisely the times when they most want to avoid showing their hand on public markets. This creates patterns in public market activity that can appear anomalous without the dark pool context to explain them. Third, if you are evaluating a broker, look at their Rule 606 disclosures and ask specifically about their dark pool routing. A broker that routes retail orders to their own affiliated dark pool has a different conflict of interest than one that routes to an independent venue. The disclosure will not always make this clear in plain language, but the routing statistics will. Markets are not one place. They are dozens of places simultaneously, some visible and some not. The price on your screen is the result of activity across all of them. Next episode, payment for order flow. Your broker charges you $0. Their biggest client is on the other side of your trade. Episode 4 explains the business model that made commission-free trading possible and what it actually costs you. I'm your host. This is Inside the Machine. Subscribe wherever you listen.